Also, take in account when you're underwriting these deals if you have any CapEx that you're going to need to put in the property in order for that property to perform with the cash flow you want to receive or with the evaluation that you want to sell that property at. Welcome back to another Upsiders podcast with me, Sofia Castro. And today I want to give you the 5 steps that Bobby and I took when we first started investing in multifamily. And this is a very 101 class. So for those that are new that into investing in multifamily, or you've never invested ever, or just wanting to get into real estate, I'm going to give you those 5 steps that are going to be very, very important for you to get all your knowledge. And this is going to be like what Bobby and I say is a stack and rack. So the stacking is all the knowledge that I'm going to give you. Because remember, sometimes when we say stack and rack, it's not all about money. It's also about knowledge. So I'm going to give you a lot of golden nuggets for you to put into your notebook and start getting all the knowledge you need so that you could get investing into multifamily. So just to highlight the 5 steps that I'm going to be reviewing with you all today so that you could understand really how to invest. Number 1 is core values. Number 2 is your A plus team. That's all your resources that you need. Number 3 is how to win at the buy, how to underwrite the deal so that you know that you're buying the right property for yourself. And number 4 is how to manage your property. And number 5 is how to scale your portfolio. So let's get into it. So step 1 is core values. Core values is super important for you to sit down and really put it on paper with yourself or your partner, whoever it is that you're going to invest with. Because knowing your core values helps so much on you not making a huge mistake on what you're investing on. So many people like to have different type of investments. So knowing, what kind of properties, what kind of industry in real estate you want to invest in, how long are you going to invest for? All of those things are very, very essential for you to protect your investment. Bobby and I didn't do this in 2000, I don't know, 4 or 5, whenever we started investing, and we got ourselves into some deep trouble. We almost lost it all because of this. How did we learn this? By the mistakes. So the next time that we invested, we knew what that core values was going to be very important. So, core values has many things underneath it. So core values, the number one thing I like to look under my core values, I have like 4 different little side steps for my core values. But the first one is property size. It's very important that you understand how much money do you have that is not going to interrupt your day to day, your month to month, your year to year living. What is it that you have in that side and that, not emergency, that's your investment fund for you to say, okay, if I have 10,000, 100,000, whatever it is that I don't need for to live on. So that's going to determine your property size. Because you could say, oh, I want to start with 100 units, but you only have $5,000 in your bank. So that no longer is not what you wish, is what you could do at where you're at the present time. So that's very important. Property size correlates with the amount of money that you have in the bank for you to be able to invest. So, having the core value in place it's you have it for a reason. That's just like a bank when they underwrite a deal, they know what they want. If you have a core value, you're not wasting your time. You're not wasting the realtor's time. it's important because time really matters, right? And also your relationship with that person. So if I say, okay, my core value right now is that I want 100 units and I have $100,000 to invest in there. If that $100,000 can be used to buy 105 units, I might look at it. It's not too far off because remember, 100 units to manage is very difficult. You add a 20 more, and you're talking about adding more employees, more management, everything. So, why do you stick to your box? Is because it's for a reason. This is the reason why I'm telling you to put in core values. Because if you just say, oh, I wrote my core values, but I'm not listening to them, I'm just going to go do whatever appears at the moment, then why sit down and really put the time into a core value? The core values are set for a reason, not to fail. You're putting yourself out for failure if you don't go into an investment understanding the responsibility, the financial means that it takes, the whole gamut of an investment. So that's why it's very important to stay within your core values when you're looking at a deal. So, under core values, what Bobby and I put in our spreadsheet when we are doing this, it's about 6 steps. It's location, property size, asset class, um, the if we're going to hold it short term or long term. We also talk about turnkey or value adds, and also our returns. So let's go to the first one, location. So let's go to the first one under core value. It's property size. Property size correlates with your financials more than anything because in order to buy a property, you have to have the money for it, right? So that really matters. So I could wish for 100 doors, 10,000 doors. I could wish for anything I want. But what does my finances are going to guide me there? So you have to first look and see how much money do you have to put into this investment. And when you put that money into your investment, you got to make sure that you don't need that money to live on. Because when you invest it at first, you're not going to get that money right away. Your cash flow is going to be slow to give back to you. You can't go back to the bank and say, I want my down payment right back. You can't refinance it really fast. So when you first start, you got to make sure you understand your finances, what you have to put into an investment. And that's going to lead what kind of property size you could get. So it's very important that you understand that first. And I always love to tell beginners, start small, guys. It's okay. You need to start at the level that you're in. When you get into a property and you want many doors because that's what's going to bring you, a lot of the cash flow, your net worth, all of that stuff, I get it. You have a plan to get there, but managing a property at the very beginning, it's kind of difficult. You have to learn all of the in and outs, just like any other business. This is a business. It's just not to say I could buy a property and just say I'm an owner to it. So you got to understand how to run your property the right way. So start small so that you could get all the kinks out. Once you get those kinks out, then you could be moving up and scale immediately, very fast normally once you get that, the play of how to manage it. So the second value that I look in my core values is location. And locations for the beginners that are just getting into this, they are classified into 4 different areas and they're alphabetical order. There's A, B, C, and D. Obviously, A is the best, D is the worst. So A is normally located in those, downtown areas where all the nice restaurants, all the big houses, that's where those apartments are located, and normally the white collar workers. B location is, those blue collar workers, your, reception, the receptionist, the people that work at grocery store, your local employees normally, you have a lot of hospitals, storefronts, those type of areas where it's more congested really because the affordability is a little better. Then you have the C location, where Bobby and I actually started when we first started investing in 2011 with our Ortsac company. And those are more like Section 8. You have normally the garden apartments, is what they call it. Those are a little bit more of a lower income areas. So, but they're still great. I love that. Whoever is getting started, I love everybody to start at a Section 8 property because it's great. We'll get into that later. And then the D location, that is a very low income, mostly government assisted living that, they normally don't work. They're mostly living off the government. So I have never invested in that area at all just because we don't understand the assets. So we just kind of stay away from it. The other one that we look at under core value is asset class. And again, this is four different ones, and they're also categorized in alphabetical order, A through D, and it's the same thing. A class is more that high end apartment that has, all types of amenities. It's very new. The vintage is new. Then you have the B assets, which is your workforce housing, still nice. You still have some amenities, but a little bit less than the A's. And then you have the C asset class, which is the Section 8, which is where I said that Bobby and I started. Those apartment buildings are normally older. The vintage is more than 30 years old, open garden apartment style. I love that asset class. The only thing is that asset class takes a lot of money for continuous maintenance because of the vintage. And then you have D class, which, it's that person that's living off the government, and those apartment buildings are really bad. Those are value adds type of style. Again, I can't give you much information on this class, asset class, because I've never invested in it. Okay, so let me give you a little explanation between location class and asset class. So, location, the land is positioned in a place where the value of real estate is always going to maintain its value. Even if the market goes down, the market goes up, that land always costs more than B or C or D location, right? So the location is the land. Where is it at? Because no matter what you have on it, the land is still valued at a very high price. When we're talking about asset class, now we're talking about the structure of the building, right? So A is a luxury new asset that has a lot of amenities. It's just very luxury. You go to B, you have, less luxury than A. Normally, again, the vintage is a little bit older now. It doesn't have as many amenities, but it's still a nice apartment. C, you have more of that garden, older vintage, meaning probably 20 years old to 30, 40, 50 years old. That asset class, that building takes a little bit more money to maintain, like I said before. And then D, it's just a different type of structure. It's more of the box style apartment buildings, very old and normally need a lot of maintenance.